listed company, if you want to leave after even putting a lot of hard work, and then the ESOP can become zero for you. Right. You may be carrying lots of hope in your books that ये तो 5 crore का हो गया, 8 crore का हो गया, but you figure out I'm sitting on 20 crore gain.
Yes.
The company have right take that back.
Deploy it back. Yes. For every Zomato, there are 100 other companies who have not done that. They'll tell, okay, you will make 2 times the salary when the stock becomes 5 times its current values. Then you suddenly realize
it's a paper.
it's on the paper, not going to happen. I was banking on this to fund my kids' education.
Yeah, absolutely.
But suddenly now I realize that okay, all this is going to go if I don't exercise.
Thank you very much, friends, for logging into my YouTube channel. And today we are going to discuss something very, very interesting, which would concern most of the employees who are looking at ESOP as a compensation or reward thing, and the company who are designing this for their employees. And I'm extremely lucky to have a person who has worked as a compensation expert for Deloitte or some other organization, and today is working independently, helping startups, established companies to design executive compensation for their employees. So I have Anubhav Gupta with me. Thank you, Anubhav, for joining my podcast.
Thanks for having me.
Can you tell something about your background, how you started, what is your background, and then what you're doing right now?
Sure, Vijay. So let me start with what I'm doing right now. I started my own firm back in July 2023. It's called Exec Advisors. So as the name suggests, we work in the area of executive remuneration. So most of our work is around advising companies, nomination and remuneration committees of the boards on effectively structuring the executive composition packages. So when I talk about executive composition, primarily I'm talking about CEO and one level below. We help companies structure their long-term incentive plans, for example, as you spoke about ESOPs, etc. So what should be the objective of these plans? What should be the structure of these plans? How much should be the dilution, and so on and so forth. So we advise companies primarily on these areas. We also do a bit of work on non-executive director composition, composition for independent directors. And we also work in the area of board governance, say, for example, board evaluation, etc. So we have been working with companies across different life cycle stages, across different industries, primarily on these matters.
Yeah. And what is your background like?
Yeah.
This is what you're doing now. Before that, what
so
you did?
Prior to starting this company, I was a partner with Deloitte, where I used to manage their executive composition practice for South Asia. So I was with Deloitte from 2019 December till 2023 July. And before that, I was with a company called Aon PLC, where again I was managing their executive composition and governance practice for South Asia.
Wow.
So I've been working in this area for last 20 odd years.
South Asia means you looked at Singapore, India.
No, so primarily India, Sri Lanka.
Okay.
So not Southeast Asia, South Asia.
Okay.
Yeah.
So Sri Lanka,
India primarily, yes.
maybe Bangladesh,
Bangladesh,
maybe.
yes.
Kind of. Okay. Thank you. So tell us that what should be, from an employees and employer perspective, what should be ideal ESOP pool of total equity of the company? It vary definitely from companies to company, but what should be ideal ESOP pool where employees can participate?
So as you said, ESOP pool varies depending on which industry you are in, what size of the company you are in. So typically, only if I start talking about pool, and there is generally a bottoms-up calculation which is done on what kind of pool is sufficient. But when companies take an approval or they go to the shareholders for approval, they typically, for a large organization, the range could be anywhere between 0.5% to 5%. When you start talking about relatively smaller companies in a startup, it could go anywhere between 5% to 10% as well. So depends on objective. It depends on a lot of factors, Vijay. It depends on who is participating in the plan, how deep you are giving ESOPs in the organization, what is the quantum of ESOPs that you are giving. All that will define what kind of pool you will require. So when you look at startup companies, right, so one of the challenges they face that they don't have too much of cash to pay to the employees. And that's where they bring in ESOPs, whereby they say, okay, while we are not able to give you cash at this particular point in time, but we are compensating you in the way of ESOPs. And when the company scales, when it gets to a stage when the listing happens, or when there is any kind of a secondary event that happens that provide liquidity, uh, employee gets a substantial wealth creation opportunity.
So I think from employees' perspective, they need to see ESOP from different companies.
Yes.
For a startup, this ESOP is basically a growth engine.
Yes.
Okay. For well-established companies, the main compensation become bigger thing because the profit pool is big for them. There in the market cap is also very big. So the ESOP pool size could be little smaller.
Yeah.
For a startup, it could be
Absolutely.
bigger. And in a startup, you'd also take risk. Established company, you take less
That's right.
risk. So the reward has to be along with the line with the risk you take.
Absolutely. And when you, if I was to step back, right, and say the objectives of ESOPs vary depending on the levels of management. So when I'm,
So I'm coming
yeah,
to that. So
sure.
the question is that should ESOP be available on ad hoc basis? Should be available for the key management person only, senior management person only, or should be available to everybody? How does a company should design, and how does an employee see the ESOP?
Yeah. So ESOPs play a very different role depending on the level of management. So every company will define a compensation philosophy, and compensation philosophy, purely if you look at components of pay, it has three components. One is fixed pay, which is your guaranteed compensation in terms of your basic salary, the allowances that you get, so on and so forth. The second is your annual incentives, which you typically get as your annual bonus. And third is long-term incentives, which ideally rewards you for long-term performance of the organization. Uh, Now, when we work with companies on designing ESOP plans, it the first thing that we ask the companies, what is the objective? Why do you want to bring this plan in? All right. Uh, so the typical answers that we get is, okay, we want to do it for the leadership team because these are the people who are going to ensure that the company is performing well in long run, sustainable value is getting created. Uh, there we look, so that performance become the primary
So
objective.
for the leadership role, it is
Yes.
the growth, the performance is the number one.
Is the number one objective, right?
And for middle management,
And for middle management, as you go down the level, those are the people who may not have the line of sight to the share price, etc. Because all these plans are equity-based plans. So if you tell a shop floor employee or a junior management employee that what is to be done to move the share price of the company, they will not know, right?
Yeah.
But they do feel honored, and they feel part of the organization if they get some equity in the company. There, it is more about retaining people. So I want to retain my top performers. I want to retain those people who I believe will form the future pipeline of leadership. Those are the people I want to ensure that they are not leaving the company, right? And long-term incentives, ESOPs, etc., acts as a very, very considerable retention hook for that.
So the motive could be different. For senior management is performance driven. For
Absolutely.
middle management is retention, and sometimes company even give to the junior most employees. I
Yes.
worked in HDFC
Yes.
Group, and
Yes.
ESOP was available to everyone.
Right.
Even
So-
even the peon got ESOPs.
Yeah,
in
absolutely. And
HDFC.
there are also many examples where there is a particular event for the company. Say, for example, when companies IPOing, it's a big moment for the entire organization, and they want to ensure that everybody is participating in this. So they, go ahead and give ESOPs to everyone. It's a small portion. It's
small
like just
portion,
like a token.
Yeah.
But it's a very event-based thing.
For people like organizations like HDFC, the small ESOP given
Yes.
has created huge value for
Yes.
people who are. And actually, for a CEO, it doesn't matter 100 crore to 200 crore.
Yes.
But for a person who's a
Right.
junior most, for even them of 2 crore,
Yes.
3 crore makes a lot of difference.
Oh, absolutely. So in some companies where the performance has been on the right side of the spectrum, you will see people have made significant amount of money through these plans as well.
Okay.
Yeah.
So, what do you think is the right vesting period? There's no right or wrong answer.
Yeah.
But the vesting period should be long, should be short. What should be the
So, Vijay, before we get into vesting, I think it's very important to kind of demystify what ESOP actually is.
Yeah, that's great. Yeah,
right?
if you can do that, yeah.
Right. So, ESOPs is nothing but, I'm giving a right to the employee to buy company shares.
Okay.
In a future date.
Right, but not on obligation.
Not an obligation. So, I'm giving a right to the employee to buy company shares at a future date at a price that I'm deciding today.
Okay.
Right. Now, this right will come to the employee after certain conditions have been
That is called as
satisfied.
vesting period.
That is called as vesting.
Okay.
Now, vesting can be of two kinds. Vesting can be time based, that you stay with the company for next 3 years and you will be able to exercise your stock options. So that's time based vesting, right? So some companies will say 100% vesting will happen after 3 years, or 100% vesting will happen after 4 years. Some companies will say it's a graded vesting schedule where it is 25% vesting every year or 33% vesting every year, so on and so forth. Typically, you will see a 3 to 4 year vesting period,
Vesting
which is very, very common in the industry.
So that is
Uh,
time based.
that is time based. Now, in some companies, the vesting is also performance based. So
Okay.
you tell the employees that it's not just you need to stay with the company, but you also need to deliver certain business results for these options to vest into you. And especially you will see this at a senior management
So
level.
the results are company specific, or the area of employees where they work is specific. So the
Yes.
employee may achieve their number, but the company may not achieve, or vice
Yes.
versa. So how?
So it in long-term incentive plans, generally you will see it is company-specific
Company
performance,
specific, okay.
because the idea is to create value,
Yeah.
and the idea is also to that everybody should be working towards the same goal.
So the alignment is very important.
Alignment
from
is
that
very
perspective.
important.
Yeah,
Yes.
yeah.
So that's where companies, especially at the senior management level, when the quantum is huge, you will see it's a combination of time and performance conditions for
Okay,
the leadership team as well.
Okay.
Now it is also important at what price you are giving these ESOPs.
Yeah, was about to come to that.
Right,
Yeah.
right.
That is
So
called a strike price, right?
that is called the strike price. So
Okay. So
what?
can you please explain what is the market price? Market price, we see market price.
Yes.
It is a listed, we know the market price.
Yes.
If it is not listed, then it depends on the funding.
Yes.
What value you give to the company.
Yes.
Explain for a layman, new employees, what is
Right.
strike price. Okay. If you
Okay,
can. And
sure.
if you can explain through illustration.
Yeah, I will explain through illustration. So let me take a classical ESOP, right, which is granted at the current share price to the employee. So
Okay.
what it means is that suppose the share price of the company is 100 rupees today. So I tell the employee that 3 years down the line, you can buy the share of the company by paying 100 rupees.
Okay.
So the idea is that employees should work towards increasing the value of the share. Now,
Okay.
suppose 3 years down the line, this value has gone up from 100 to 400 rupees. So there is a benefit of 300 to the employees. So after 3 years, once the vesting conditions has been satisfied, employee can exercise these options.
So suppose the company has given them at current market rupees of 100 rupees,
Yes.
and the price become 200, 300,
Yes.
400. Then the employees can pay 100 rupees, buy the shares
Yes.
in his demat account,
Yes.
and then he can sell or retain.
Yes. Absolutely.
And
That's up
he
to him.
can,
So one important aspect, Vijay, is that after vesting, companies define an exercise period. You have to necessarily exercise your stock options within that period. If you don't exercise your options within that period, those options expire.
So suppose in the given case, for
Yes.
instance, first is suppose the it is given at 100 rupees the current market
Yes.
price, and 3 year down the line it is 400 rupees.
Yes.
And 3 year down the line could be 80 rupees as well.
80 rupees.
So
as
if it
well.
is 80 rupees, employee may not exercise because
Yes.
the loss making
Employee
proportion.
will not exercise
Employee
because
will not
we
exercise.
call it underwater option. If you want to buy the share, you are better off purchasing from
Purchasing
the
on the
market,
market,
rather
yeah,
than
yeah.
exercising your options.
So in a way, it is a sort of insurance. Only when it goes up you buy. If it doesn't
Yes.
go up, you don't buy
Yes.
it. Okay.
And that is how you align it with the shareholders' interest.
Yes,
You are
absolutely.
saying that, okay, value goes up of the company, shareholders gain, and you also gain because you are the people who are responsible for creating that value.
Yeah.
So you get a share of that value. Right?
So the company gave shares at 100 rupees and told employees that it will be vested to you after 3 years.
After
So
3
suppose
years.
2026 June, July.
Yes.
June 2026, company is giving ESOP at 100 rupees and telling employees that by June 2029,
Yes.
these what a number of shares will get vested in your account.
Options will get vested.
Option will get vested. Now, at the end of 3 years,
Yes.
the employee may or may not exercise the
Yes.
option.
Yes.
Okay. After 3 years, we call vesting window.
Yes.
Right? 3 years is a vesting
It's
period.
the vesting period.
After 3 year, company would say you need to exercise this vesting in a certain time period. That is
Yes.
known as a
Exercise period.
exercise. What should be the ideal period?
So typically in India, for at the money options means the options you have granted at the current price. You will find companies giving anywhere between 4 years to 5 years post vesting for employees to exercise.
So let
these
me just
options.
get it. June 2026 ESOP granted.
Yes.
With the vesting period of 3 years. So in June 2029, vesting happen.
Yes.
And if it is in the money, it
Yes.
means that the current market price at 2029 is more than the price at which the ESOP has been given
Right.
to the employees. In
Right.
our case, 100 rupees was the exercise price,
Right.
right?
Right.
And in 2029, the
Right.
price is more than 100
Right.
rupees, and it is in money.
Yes.
Okay. Then after 2029, the employees have option to exercise this in next 3 years. What
Next
are the time
4 to 5
period?
years. Yes.
4, 4, 5 period.
Yes.
Okay.
So it's a so what happens is, as you said, the value of share can go down to 80 also. Now, suppose there is a blue swan event that black swan event
Yeah,
that
yeah, it
happens.
can happen. Yeah,
COVID happened or
Yes,
anything
yes,
that
yes.
happened, and the price went down for the company has been doing well, but because of externalities,
yes.
the price has gone down. Now it's not fair, so that the value has gone down, and that the price will come back
Will
as
come
things
back.
improve. So that's why a longish period there, right? So you will have 4 more years or 5 more years to exercise these stock options. An employee can wait. They also remember that employee has to pay that 100 rupees.
Yeah.
And the second thing that the employee has to pay is the tax, because
Yeah, just explain.
Yeah.
So, 100 rupees is the current market price at
Yes.
which I'm giving this option to the
Yes.
employees.
Yes.
Okay. So, on that 100 rupees, I'm so that 100 rupees employees need to pay.
Yes.
That is the excess strike price.
Strike price.
Now, the exercise price, there's this strike price or exercise price,
Yes.
whatever you
Yes.
call it. Okay.
Yes.
Now, the current market price in 2029 become 400 rupees.
Yes.
Suppose you exercise for vesting, suppose you vest the shares in the name of employees, and suppose the current price is in June 2029 is
Right.
400 rupees.
Right.
So the gap between 100 rupees is buying,
Yes.
400 rupees is the market price,
So 300 is the gain.
300 is gain, and I believe this is tax at the marginal tax rate, is not tax at long term, short term,
Yes.
right?
Yeah, absolutely.
So it is a
This
perk for the employee.
It is perk for the employee. So you will be taxed as per your salary slab.
So 100 rupees is my buying price, 400 rupees the market price,
Yes.
or 300 rupees gain.
You need to pay
It is
income
it is
tax.
a sort of a salary.
Yes.
So maybe 100 rupees I have to pay, knock
Yes.
off.
Yeah.
So how do I fund it?
Right. Absolutely. So that's a
Because I don't want to. I'm saying I want to
Yes.
exercise. I want to
Yes.
get it vested,
Yes.
but I don't have money.
Right. So that's why again a long exercise period helps.
Okay.
Because employee can manage.
Okay.
Where
So I'll say
rich.
I'll just take 5% right now. I'll take.
Yes.
Or someone would say I'll sell,
I'll sell.
pay the tax,
Absolutely.
and जो net आएगा वही लेता हूँ मैं.
Why? Absolutely, they can do
So
that.
there's-
Or they can also take a short-term loan from.
Loan but
NBFC
that you need to take a
exercise.
call on the company. That company will do much better. I don't want to sell it.
Yeah, so generally those shares that you exercise are taken as a lien, right? As
But
those shares.
that you in that case you take a call
Yes.
that the future will be much better.
Yes, or what I can do is I can sell some shares. So I
Yeah.
need only 100 rupees and 30% tax, 35% tax to pay. So I exercise some of the.
So I become
options.
cash neutral.
I become cash.
So suppose I have 100 rupees shares given to me, 110, 20
Right.
rupees is tax.
Right.
So I'll sell to the extent of fund to 20
Absolutely.
rupees.
Absolutely.
And rest of the shares are in my account. So
Absolutely.
in that scenario,
Yes.
I lose out on future opportunities. Suppose the share price goes
Yes.
up, but I also protect myself. Suppose share price goes down in future,
That's right.
at least I'm not negatively
That's
impacted.
right.
So that is the every employee need to
Yes.
be mindful of their own financial situation and then take a call. Is
Then
that
take
right
a
thing?
call. Absolutely. So
Right.
it depends on the individual on how you are viewing the stock. And in fact, some companies now also give this facility where it's called cashless exercise. So the company manages this program through a trust, and trust can sell some shares on employees' behalf to cover the exercise price and the taxes, and SEBI allows for that.
So, but is basically doesn't matter from a cash flow
Yes.
perspective. Remain the same.
Right.
Earlier he would get 1,000 share. Now he'll get 600 only.
600, yes.
It is end up
But
the same.
from the employee standpoint, it becomes
Less
beneficial.
hassle.
Less
Less
hassle.
hassle.
It doesn't have to worry where that money is going to
that
come
money
from.
is going.
Yes.
Okay.
Yes.
Great point.
Yeah.
So you tell me we discussed the vesting period.
Yes.
And you said vesting start can be immediately after 3
Right.
years, or some companies can do after 1
Right.
year or so. And exercise windows, you said
Yes.
typically it is pretty longer. What happens that we're talking about listed company, that is fine.
Right.
I'm working with X bank
Yes.
and I got ESOP,
Right.
and suddenly I got an offer from a competition,
Right.
and I found the offer to be very good.
Right.
I just go and sign the letter, and then my company get to know. I put a resignation letter. They say, boss,
Right.
you're joining competition.
Right.
There's a clause in ESOP where you can't join the competition. You
Right.
join the competition,
Right.
unvested shares are taken back.
Yes.
Can company take back vested shares as well?
Generally, they don't.
Okay.
But they give a very small window to exercise those vested options.
Okay.
So it's not that the entire exercise period is available to you if you're resigning from the company.
Yes, yes.
So they will either say you need to exercise whatever is vested by your last working day, or you have 3 months or 6 months to exercise your vested options. They will not allow full 5-6 years. Very rarely companies do that. So it's a small window to exercise those vested options, but unvested gets forfeited by that.
Unvested get forfeited.
Unvested.
So if you are resigning,
Yes.
you should be extremely careful. Look at the clauses of ESOP letter.
Yes.
What does it say
Yes.
about the vested stocks, about the window available
Absolutely.
to exercise the option?
Absolutely.
But once the shares has been exercised, nobody can take that back, right?
Yeah, because the shares
that has
have
gone
come
into your
to you.
demat
The
account.
shares have- Now again, a very good point, Vijay, because especially in the unlisted scenario, employees have to be very, very careful because these shares are not liquid, right?
Okay.
So companies put all kind of conditions in the scheme, right? So it is very important for employees, especially at the senior management level, to read the fine print on what the scheme is saying.
So tell me what are the in listed? There's no problem, right?
Listed, generally there is no problem.
Generally, it means there's a problem. There could be a problem.
There could be a problem.
Like, but listed.
Like for example, some companies will say you have only 30 days to exercise your vested option.
No, I'm saying
right, or
excess stocks has been exercised.
then it is in
It
listed
come in my
companies, it's
demat
not a
account. It has come in my demat account, and nobody can take that
Yes.
back, right?
Yes. So in a listed company, there is not
There's
an
no
issue.
problem. So
Yes.
let's go step by step. Vested exercise.
Yes.
Nobody can touch it.
Nobody can touch it.
Vested not exercise.
Yes.
When I resign, there's a limited window available.
Yes.
Okay.
For the
Unvested.
listed- Now let me come to unlisted companies. So
No,
this
we'll
is-
come to the listed
Yeah, sure.
first.
Okay.
So vested,
Mhm.
resign, less window available.
Yes.
Unvested,
Forfeit.
there's a potentially the company may forfeit.
Or generally in all cases they forfeit.
Generally, in all.
Yes.
So suppose I'm joining a company.
Yes.
Suppose I'm joining somebody
Yes.
and I'm signing a ESOP.
Yes.
I should be also mindful when I sign those ESOP. I should negotiate with the company that I'll not leave for 3 years. But if I leave after 3 years,
Yes.
you can't take away unvested stock. Is there a case in India where employees has agreed, some CEO level person has agreed, or does the company don't give this kind of proof?
Companies generally will not give this because the whole idea of vesting is to keep the employee in the organization. So if you're not staying till the vesting has been done, so that's why this is the requisite service period, right?
Okay.
So the vesting period denotes that.
Okay.
So if I'm saying vesting period is 3 years, that means you need to stay in 3 years for this to.
So vesting one is that unvested goes away, I resign.
Yes.
Okay. And vested, the company may give less option for me to exercise.
Yes.
That is in the case of resigning or I'm joining a competition.
Yes.
What happened because if I've been sacked because of integrity issues or some sexual harassment issues or whatever?
So then typically both vested, vested that are unexercised and unvested, both are forfeited.
Oh.
So in every scheme, you will find something called termination for cause. So
Okay.
every scheme document will define 4 or 5 clauses on termination. Right?
So what are these typical clauses are like?
I'll tell you. So for example, there could be an untoward event like a death or a permanent disability where the employee is not able to continue with the organization. Right. So in that case, typically companies will say that all unvested options will also get vested immediately, right? And employees generally will have full term to, or their legal heirs will have full term to exercise those terms. The companies are generally very liberal. SEBI also says that
About when death or disability,
death and
vested period is capped, but unvested shares are
unvested
taken.
also gets vested immediately.
Acha, so in certain in
Death and
humanitarian ground,
Right.
okay,
Right.
death and disability even unvested get
Yes.
vested, but then get the
Yes.
full window 4 year, 5 year, whatever the
Right.
window. is.
Generally, right.
Generally, okay.
Now, there could be a case of resignation, right? So now, in the case of resignation, company will say that, okay, since you have performed your service till the time the vesting is, so all vested is yours, but you only have 3 months, 6 months to exercise these options because company don't want to carry the
Yeah,
vested and
absolutely.
excess
You
for a
become
very long
public
time.
shareholder. I want to
Yes.
employ shareholder.
Yes, yes. So you do that, but unvested gets forfeited. Now there is termination for cause.
Okay.
Now termination for cause means, as you said, that there is some felony or
Financial integrity,
Financial
data
integrity,
security.
those kind of
Now
things
data
are
security has become
Yes.
very big thing today.
yes.
Yeah.
So now in that case, both vested but unexercised options and unvested options will get forfeited.
Okay.
Now companies are going step ahead
Hmm.
because in some of the industries which are regulated, like banking you mentioned or insurance you mentioned, it's mandatory to put clawback clauses, uh,
Oh,
right? That if the act like financial integrity, if some wrongdoing was doing say 3 years back before it came to the
suppose in
notice.
mutual fund industry somebody
Yes,
was doing front running, or
yes, yes,
in banking industry
right,
somebody was giving, like,
right,
discover that
yes,
loan was given for other
right.
consideration.
So even the previous gains that you have got from ESOPs can be clawed back.
So you have to, you gorge the, you takes away the,
Uh,
suppose I exercised the option, I sold as well,
right,
or I didn't sell, but
right,
I'm sitting on 20 crore gain,
yes,
the company have right to take that
take
back.
claw it back. Yes. So
Oh.
there are two important things that are there in the schemes. One is clawback, which will allow the company to claw back all the gains that you have made previously.
Even after exercise
Yes,
vested
yes,
everything.
right. And then there is something called a malice clause,
Hmm.
which says that you cannot exercise whatever has been vested. They put a restriction on that, or you cannot vest even. So that's there is a restriction
So
on that.
even the shares has been vested, but the
Yes,
employees has not exercised.
yes,
So saying in certain events,
yes,
uh, even vested exercise option can be taken, because once you find out that you
if
made
there are integrity issues,
integrity
yes,
issues,
absolutely, yes,
and in certain cases, the vested can be taken away.
right,
Unvested is completely finished. Okay,
yes, yes,
unvested can be taken away. So
right.
what employees need to be careful of?
Yeah, so they need to, as I said, read the fine print very carefully on
Okay.
what the scheme says, especially the senior management level, because this quantum could be very huge at
But in many
those
company,
levels.
what I've seen that employees goes to HR से यार मुझे पता नहीं आप इसको देख लो.
Yeah,
Is that happen because ये lawyers ने draft किया है?
right. नहीं,
So where does the
so
employee go? Because suppose
it's
I say financial integrity, data
yes,
security.
yes,
See, certain different companies have.
yes,
For instance, let's look at asset management
right,
company. There's SEBI rule that one need to
right,
invest so much into their own scheme,
yes,
and there's some technical error.
yes, yes,
Somebody forgot to report, or whatever the reason,
yes, yes,
or in the banking industry, whether bad loan was given because of financial integrity issues, bad
yes.
judgment. How does one take a call?
Yes. So India, that's a little bit of a problem because everything become litigious, and it takes a very long time to arrive. That what was done as normal course of business, you
Hmm.
can take a bad call as a business, right? You gave a
Yeah,
loan
yeah,
which went
yeah.
bad.
Hmm.
It doesn't mean that there were financial integrity issues,
Hmm.
right? But there will be cases where something was done knowingly, right?
Hmm. Hmm.
Cooking of books, etc., etc.
Hmm.
So there is a long period which goes into the investigation,
Hmm.
right? Then the employees also at times challenge it,
Hmm. Hmm.
especially at the senior levels. And
Hmm.
we know some banks, the cases are going on. We'll not name the companies, but
Yeah,
we
it is
know that.
public knowledge
Yeah,
what is happening
yeah,
right now.
yeah.
Okay.
So you
So
see, the decision has not been taken till now,
yeah, yeah,
right?
I know. Yeah,
It's
yeah.
still open.
So what employees need to be careful?
Yes,
Senior management is fine, but
right.
what a normal employee need to be
See,
careful?
so for normal employees, what I believe is there is what we call survivor bias in the market. So
Hmm.
we have seen a lot of startup companies do really well. They've gotten to a stage where there is listing which has happened, or there is secondary sale that has happened, and employees have made a lot of money. But there are, for every Zomato, there are 100 other companies who have not done that. So you need to be careful about the terms and conditions of the scheme,
Hmm.
right? So when you are, say, at times when when an employee is joining, the HR will say we'll give you options which will be 2 times your salary, right? Now employee needs to understand what does that mean, 2 times salary,
Yeah.
right?
How does value it
How to
in
value it,
unlisted
right? So when
company?
you join the company, they'll tell, okay, you will make 2 times the salary when the stock becomes 5 times its current value. So then you suddenly realize
It's a paper.
it's,
It's
it's,
on the
it's not
paper.
going to happen, right? Or
Yeah.
even it may go 2 times, 3 times, but it may not go 5 times. So those are the things people need to be very, very careful about.
Hmm.
In unlisted scenario, Vijay, the most important thing is liquidity of shares.
Yeah,
Right?
please explain that.
Yeah.
No, my first concern was that
Yeah.
about financial integrity, sexual harassment, data
Yes.
security. What are the things you have observed in your career where vested option has been taken away? So just can you tell some senior management? We all know, but I'm
Yes.
talking about middle management, junior managers.
Right.
What are things they need to be
So in
careful?
these cases,
Hmm.
the scheme is absolutely clear generally, right? That
Hmm.
if there is any for cause termination or misconduct or sexual harassment, as you mentioned, companies are generally very strict on this.
Hmm.
So scheme is also very clear about these aspects, and it's very clearly written that if any of these events happen, everything will get forfeited, right? Clawback is generally in the case of financial integrity, etc.
Extreme.
Right? But anything which is vested but unexercised, and everything that is being unvested, company takes it away. There is no appetite for any leeway there.
Tolerance for
any
these kind.
tolerance
No,
for
that's
this.
fair. That
Yes.
होना भी नहीं चाहिए.
Yeah, तो वो होना भी नहीं चाहिए. I think it sends a very right message.
Okay.
But that's, I will say those cases are there, but rare. What impacts the larger population is what are the terms and conditions around liquidity of those shares, right?
Okay, so explain more about this. So first thing, employee need to read the ESOP communication letter very, very carefully.
Very, very carefully.
Any addendum coming, any changes happening, they
Yes.
should read it very, very carefully.
Very carefully.
They should keep record of all the communication which they receive about the ESOP
Yes.
and dust it off and read it regularly.
Absolutely.
Is that right? Every 3 months they should read it.
No, absolutely.
And particularly when they are looking at resigning from this company,
Yes.
they should read it very, very
They should know
carefully.
what their rights are when they are resigning from the company. And that's where Indian markets, differ from what we typically see in the Western markets. So very recently it happened with OpenAI. There was some issue on, they were planning that even the vested options, right, employee will have to, forego if they don't exercise within a particular point in time. But they said, no, vested is vested, right? Now, see, the problem is in unlisted companies, we don't know when the liquidity event is going to happen, right? So we don't know when the IPO is going to happen, when you will see the money. Now, suppose there is an employee at a junior management or a middle management level, you got ESOPs and you were happy with how the valuation is growing, because in private markets, valuation, when you're raising the fund, etc., the money is, you see the paper value there, but you have not realized that value. You have vested options. Now you have not exercised because you don't want to put your money in an illiquid stock as of now, right? Because it's not, you can't sell those shares anywhere, right? But you have to pay tax, you have to pay the exercise price. So that is outflow that happens. Now you are holding a share which is at unlisted stock.
So basically now you are taking a naked position. You're putting your own money.
Yes.
So let me explain. Let me understand this a little clearly.
Right.
In unlisted company,
Yes.
The stocks have no liquidity except company like NSC. It's a different story. Or some great company like HDFC Life Insurance, when it was unlisted, some big brand.
Right.
Normal startup, liquidity is a concern.
Liquidity is a concern.
So the startup started, ESOP gave ESOP, gave whatever value it gave. One round of funding happened, 2 round of funding happened, 3 round of funding, company's valuation kept going up.
Right.
Your vested shares was 1 crore rupees.
Yes.
That was a vesting strike price.
Right.
Now, according to round 3, the 1 crore has become 10 crore.
Yes.
And now the vesting period is getting over.
Yes.
After vesting
Right.
date and vesting period getting over. Now you're in dilemma.
Now I can exercise, but I need to know how long do I have to exercise these options.
And that
What's the
nobody
period?
knows.
That is in the scheme document. So that's why I'm saying it's very important to read the
So
scheme.
scheme document में क्या लिखा है?
स्कीम
Public-
डॉक्यूमेंट में लिखा होगा कि आपके पास कितना टाइम है इन ऑप्शंस को एक्सरसाइज करने के लिए.
So even in unlisted company, after say 5 years,
Yes.
my vesting period is over. I
Yes.
got all the vested shares
Yes.
in my account. Okay,
You have not.
you're not unvested है because
नहीं आप देखिए अभी ऑप्शंस वेस्ट हुआ है.
हाँ.
अभी आपके पास कोई शेयर नहीं आया है.
oh
अभी आपके ऑप्शंस वेस्टिंग का मतलब है राइट टू एक्सरसाइज हैज कम टू यू.
okay vesting हाँ ठीक है.
सो देयर इज अ पीरियड नॉट बीइंग डिफाइंड कि आप इतने टाइम तक
So
एक्सरसाइज
after
कर सकते
3,
हैं.
so I was given ESOPs today. 3 year down the line, this I can exercise the option.
Yes.
And from that 3 year window, I have a next 4 year. During that period, I can exercise these options.
Now, for unlisted company, whether it is 4 years or 5 years or
Nobody-
6 years or 10 years,
That
that
is
is
when-
very important.
Not only that, also important that at what price you exercise and
Absolutely.
from where you're going to get the liquidity.
Absolutely.
Because you can't sell in the public because it is unlisted.
Absolutely. Now, see, take a situation, Vijay, where you are in an unlisted company. An unlisted company says, okay, this gets vested after 3 years. Now you have 3 more years to exercise. Now you are sitting in the 6th year, right? Now you say that, okay, I don't have any line of sight to when this company is going to get. When do I get liquidity? Because IPO is not in sight. There is no secondary which is happening, etc. But if you don't exercise,
You lose everything.
you lose everything, right? So is that a fair plan, right? Now these are the things that people don't read when they sign.
So does company have buyback plan? We don't know that.
forget about the buyback. There is no share as so there.
Because if it, after 6 years,
Yeah.
your exercise window also get over,
Absolutely,
and
right.
you don't have liquidity.
Yes.
Even if you have liquidity, the
Right.
question that even you put money right now,
Yes.
you
don't know when to encash.
whether this company is worth that much.
Yes, absolutely. So those are the things which now what some companies have done, and say for example, I say exercise is only possible at that liquidity event. So I say it gets vested, but exercise will happen.
So
only
that
at
is
the time
most
of
fair,
liquidity.
right?
That is fair. That is fair because it gives employee also the time, right?
So what you're saying that for unlisted companies, suppose
Yes.
you're joining, it is very important that you figure out
Yes.
when the vesting period get over, when the exercise period get over.
Yes.
At that time, it is linked to liquidity, then it is one of the best plan.
Yeah.
If it is not linked to liquidity, then
Then you
it
have to
is
be
a
careful.
risk.
Then you
So
have
the
to be
employee
careful.
need to read the ESOP document very
Very carefully.
carefully, and before signing a startup or a new venture or unlisted company,
Yes.
they need to make it very clear that when I vesting my shares
Yes.
or when I exercising my right to vest the shares,
Yes.
I do have a liquidity provision available.
Yes, and companies see. Idea is from the company standpoint also, Vijay, is not to make the plan difficult. Otherwise, it will be very
Exactly,
difficult
nobody
to
will join. Yeah,
join
yeah,
them,
yeah.
right? So companies are also from their standpoint giving a lot of avenues for liquidity when the IPO is not happening. So there are
So what are those kind of things?
sure. So for example, there is something called a tag along right.
Okay.
Now, how the tag along right works is suppose the existing
But just come to tag. Is the tag along right given to all the ESOP holder, or it is only given to senior management?
no, it's generally given to
Generally
given,
but not necessarily.
not necessarily. But
So even I'm saying, even employee need to be very careful about these things.
yes, absolutely. But
Yeah.
if I was to give, I will probably give it to junior level employees more than
More
the senior
because
level.
they are more vulnerable.
Right. So tag along is when if the existing shareholders are selling their stake right to another investor, then employees can also proportionately sell some of their shares. So that provides them liquidity, or even if it's a capital raise which is happening, but it's happening in the private market, and the new investor says that okay, I am buying 10% of this company, but I am willing to buy another 2% if the employees are willing to sell, right? So
The
that
same price, yeah.
same price. So again, they get that liquidity, etc. So those are the kind of things which are very, very common.
So the IPO,
There could be IPO, there could be tag along.
Tag along, right.
There could also be a provision whereby there is a buyback from the company,
buyback from the
right, or through a trust or a group company. So those kind of provisions are also.
But that will not get the same price because
Companies don't commit to it.
yeah.
They keep it open. They will say we may buy it back. They will never say that we will definitely buy back because then it's a commitment, right? So they don't do that.
And generally buyback doesn't happen in unlisted at the same
Yes.
perhaps the same price where it could go in the public.
So then you go to a banker and you say that okay, we want the valuation of the shares to be done, and they.
But then the company need to put money
Yes.
to buy shares.
Yes, absolutely. It has to be funded.
I have heard that in many times when one company gets sold to another company,
Yes.
the other company, the buyer say we don't have anything to do with ESOPs. What happens? Suppose a smaller company was taken over. I start up my own company,
Yes.
very small company.
Yes.
Then some big wealth company comes and say, Vijay want to buy out your company.
Right.
Great.
Right.
Many times we have seen that the small ESOP holders are given shorthand in that process. What
So
happens?
again, that's why I say scheme document is a very, very important. So every scheme document will have something called a change in control.
Okay.
Right. So what happens in the case of change in control or a corporate action? Right. So suppose the company gets sold. So what is the right of the employee at that particular point in time? Now suppose there is a company that has bought, they don't have an ESOP scheme, right? So now you say, okay, I'll settle everything for you, right? That's one way to do it. Or they say, okay, we will assume your stock. So if suppose that company also has their own scheme, so these options.
How does
get
valuation
transferred
happen then in these two companies?
So through the ratio, the same ratio.
Okay. The way the merger happens.
The way the merger happens typically.
And suppose the company buy out cash, then employee can also get the cash.
So SEBI is very clear that any change or corporate action, you have to do the adjustment which is not detrimental to the interest of the employee. Right. So companies typically will adjust in a way. So say for example, if it's an all share deal which is happening, right? So in the same ratio, the options will get converted. Now the exercise price will also be adjusted so that the employee is not shortchanged in any way.
And suppose the buying company don't have ESOP plan.
Then you have to think on, and there are companies. I was just recently working with a pharmaceutical organization where they did a few acquisitions, where those companies had a plan, but parent company didn't have
The buyer company, buyer that buyer.
didn't have a plan, right? So now what will happen is you either settle those options. So you will say, okay, we will do a valuation. We'll see basis what, valuation of the option, and we'll settle you in cash before you come in. The second thing that these companies can do is, okay, we will create a new scheme now. Although we don't have a scheme, we'll create one scheme now. And
But again,
then
this
transfer it
is
everything.
then again is opening a new Pandora's box, because what valuation?
What valuation, etc. Then if you don't have a plan right
Yeah.
now, then you have to give to your own employees also.
First, yeah,
Otherwise,
yeah.
they will say,
Yeah,
the
yeah.
acquired company employees came, they are getting something, we are not getting anything, right? So those kind of things also.
So it is very, very important that the ESOP document and
Yes.
communication is read very, very carefully
Very
by the
carefully.
employees.
I'll
Right?
tell you, especially
And
in
please
the
give some illustration where the
See,
employee
yeah.
felt
So in
shortchange
the-
or whatever.
A short change, I'll give you a lot of examples, right? So again, one is when the company says that we are going to give you X value of shares, what does that mean? You have to double click on that. I have seen even CEOs burn their fingers when they were told that we are going to. So CEO is joining at a 5 crore compensation, for example, which is like
And that
fixed
make a lot of
rate.
headlines.
So they say that, okay, we are going to give you 5 times opportunity in ESOPs. So 25 crores opportunity. So what does that mean, right? So that's the question to be asked. So is that the cost of ESOPs, or is that the earning potential of the ESOPs? Or if it is earning potential, then what is the IRR that you expect for me to deliver to get to that 25 crores? So you need to be very careful, signing on those kind of things. In unlisted company, again, talking about how people get shortchanged. Suppose they say, okay, if you leave the organization and my vested options, say for example, I'll give only 3 months, 6 months for you to exercise. Now you'll say, okay, I am leaving this company. I've served for 3 years, 5 years. That's why I've got these vested ESOPs. Now you have given me such a short period to exercise. And when the company is unlisted, I need to put in my money to exercise these options. I need to pay tax as well, right? And I'm getting an illiquid stock. So that's not fair. And if the employee doesn't pay that money, those options expire.
Yeah, very
Right.
interesting points. You are saying in a listed company,
Yes.
if you want to leave after even putting a lot of hard work,
Yes.
and then the SOP can become zero for you.
Right.
You may be carrying lots of hope in your books that
Yes.
ये तो 5 crore का हो गया,
हाँ.
8 crore का हो गया, but
Right.
you figure out that
So that scheme document is very important. Another thing that happens in unlisted companies is at times there is a 100% stake sale that happens. Right? So some schemes will have a drag along right. That means they have a right to drag all the shareholders if the 100% stake sale is happening. Right? Suppose any company, they were giving ESOPs to employees and 5% is sitting with the employees. Now this company wants to sell 100% to somebody. And the other party is saying, okay, I'll buy only if it is 100%. So there is a drag along clause in the scheme where they can force you to sell your shares
at what price?
at whatever the transaction price is.
Whatever.
But you have to sell. Suppose
You don't have option.
you don't have option.
And you have to pay taxes.
You have to pay taxes. So it's a part of the scheme.
It's a
So
part.
that's why I'm saying, are you okay with that? I'm not saying it's anything wrong.
No,
because
exactly.
you have to
lot
protect
of-
company also.
So a lot of time people feel
Right.
shortchanged because they don't read it.
Yes. So it's a surprise to them.
It's
after a
surprise to
point.
them.
If
Yeah,
you
yeah.
knowingly do this and you are okay with it, because see, you have to protect interest of all the stakeholders. So companies also, I have seen also, instances where employees have created a nuisance. Say for example, there was a CEO who was holding 2% in the company. Now 100% stake sale. This CEO said, I'm not going to sell. So it created a huge ruckus for the company, right? Because he was not willing to sell. Had they had drag along right in their scheme document, he would have been forced to sell.
So it is very important to have a drag along right
From the
tag along
company
right, from
perspective.
the company's perspective.
For employee perspective, it is very important to have a tag along right.
Tag
in the
along
company, right?
And for employees,
yes.
company's perspective, drag along
Yes.
right, the tag along
Yes.
right. So it is
So
very, very.
it has to be very balanced scheme, which is protecting the interest of the company also. It is protecting the interest of the employee also. It is protecting the interest of the investors also. So it has to be well balanced, from all perspectives.
Okay. And so the employees need to read it carefully. Employees needs to also know the tax implication at every
Yes.
time, every event.
Yes.
Employees also need to be aware about tax outgoes and
Right.
tax flows,
Yeah.
cash flows to buy, exercise.
So it's funny, you said tax, recently I was taking this session and the holding period to get into the long-term capital gain tax bracket is different for listed equity and unlisted equity.
Unlisted is 2 year, listed is 1 year.
People don't know that.
Ah. Yeah, that's very true.
Right?
It's
So
such a small thing, right?
it's a small thing, but people don't know that. People say, okay, it's equity,
एक
it's 1
साल हो
year.
गया
एक साल हो गया तो long term में आ जाएगा. पर वो 2 साल holding period है वहाँ पे.
very very important to know all these
All this nuances. And enlisted stock, again, short term capital gain is different.
short term capital gain is
It's
marginal.
It's marginal in
It is not 20%, it's marginal.
It's marginal.
So unlisted में तो और झमेला
और
है.
झमेला है. तो इसीलिए बहुत इंपॉर्टेंट है ये सब चीजें पता होना और ये सब चीजें समझना, और इट्स कंपनीज रिस्पॉन्सिबिलिटी आल्सो टू
Explain as
that
well
to
as
the
employees' responsibility to protect their own
Yes,
interests. So it is very
absolutely.
important from that
Yes,
perspective.
yes, yes.
Anything else you would like to share, Anupam, from employees' perspective? What one need to do? What are the things you observed?
Yeah, no, I think it has, this instrument has worked wonderfully well.
Yes,
For a lot of companies. I keep saying to all my clients that it is the objective which is very important, right? As I said at the beginning, for the leadership team, it is different objective. At junior management level, it's a different objective. Uh, the overarching objective is to create value for
It is a
shareholders.
win-win kind of thing.
It's a win-win kind of a thing. I'll just like to highlight again, since I do a lot of work with the senior leadership ESOP plans. Change in control, I briefly mentioned. Now that is very, very critical, right? Because if the ownership changes hands, how do you define change in control? So
And many times I've seen, Anupam, that the technocrat don't understand these things.
yes,
Engineer, he's a great asset to the company, but
Right.
this guy is very poor in financial management and all these, right?
Yes, no, absolutely, and that's where they don't understand the nuances. It's a responsibility of the company to give them that information, but they also, as people say, buyer beware. You need to know, understand. Senior people, will sit with a lawyer to sign on the document,
Exactly,
right?
yeah.
But middle management, junior man, you can't do that, right? So it's
No, I've seen, for instance, doctors.
Yes.
I've seen technocrats.
Yes.
Okay, scientists.
Yes.
Who are brilliant in their field, but when the document comes, they don't know how to read.
They don't know how to read, and they feel
they don't have
shortchanged after a
bandwidth.
point
They
in
don't.
time.
They don't have bandwidth, unfortunately, because the mind is too preoccupied with their own skill,
Right.
craft. So they are so good at that many times I've seen people doing that. Yeah, absolutely right.
And when these people feel shortchanged after 3 years, 5 years, putting all the hard work, I know people have told me that I was banking on this to fund my kids' education.
Yeah, absolutely.
But suddenly now I realize that all this is going to go if I don't exercise. So a company says it's too bad, right? But so that's why you have to be very, very careful. So it's important to spend some time on understanding the scheme, etc., and question the company also on how.
So the message, viewers, to all the guys who are joining new companies or changing employment, please read the ESOP communication, ESOP plan very, very carefully. Second thing, talk to ex-employees. Talk to people in the same industry. If you have a lawyer friend, consult the lawyer friend. You can reach out to Anubhav as well to take his help. And I'm going to cover in my video few months later, how does one manage ESOP wealth? Because we have seen ESOP become a very big part of the total portfolio of a person. And people get very emotional about the company in which they work. And we have seen company goes through challenging time. So it is very important you de-risk your ESOP wealth over a period of time and put it in a very structured way rather than very emotional or non-rational way. For that, we have designed a ESOP plan strategy for wealth creation. I'm going to unveil this in a couple of months going forward. So do tune in, and thank you very much, Anubhav, for joining and giving very interesting insight to us. If somebody want to reach out to you, what is the best way to reach out to you?
My website is exec-rem.
Can you spell out?
exec-rem.com.
Okay.
Our email ID is there on that website.
So, Anubhav, tell me, for leadership team, what is important when company change hand or some change of shareholders, leadership को क्या देखना चाहिए? What I think they should be careful.
So it is important for the members of the leadership team, CEOs, CXOs, to know what happens to their ESOPs in the case of change in control. There are two things. If the change in control happens and you are continuing with your role, right? So then it's a normal course of time. The company will assume your ESOPs and it will continue to vest as they were supposed to vest, etc. Right? But suppose you are asked to go after the acquisition. So now,
Or not asked to go, but given lower position.
or a lower
CEO को
position.
CEO बना दिया, CEO को
तो
head of
दो चीज़ें
department.
हो सकती हैं इसके अंदर। एक होता है कि जिसको हम डबल ट्रिगर बोलते हैं कि चेंज इन कंट्रोल हुआ, दैट इज ट्रिगर वन, एंड यू लीव योर एम्प्लॉयमेंट इज गॉन, दैट इज रीजन नंबर टू। नाउ व्हाई इज योर एम्प्लॉयमेंट गॉन? अब कंपनीज एक्वायर हुई, अब दो CFO हैं, एक ही चाहिए, राइट? तो यू आस्क वन पर्सन टू गो, सो व्हाट हैपेंस टू हिज और हर ESOPs, राइट? Now that is or say for example, as you were saying, that there is a CEO, right? Now after the acquisition they say, okay, you are not going to be the CEO, you're going to be the chief operating officer. Now that's a good reason for me to leave the company, right? So if the termination happens post change in control without cause, so there was no felony or anything, so you were just asked to go after, so what happens to your ESOPs? And what happens to your ESOPs if you have a good reason to leave? These two things are generally defined in individual contracts, not in the scheme.
So it is very important when you sign as a senior manager, you need to be very careful about
Yes.
these things in our employment agreement.
Absolutely.
Again, there are many people don't do that.
Many people don't do that, right? And it's very important to consult with your lawyers, to consult with the experts on what should happen, because it's no fault of yours, right?
Yes,
So
yes.
now you are saying, okay, I'm asked to go, so you give my invested should ideally accelerate and gets vested,
yes,
right?
absolutely.
If I have a good reason to leave, I joined this company as a CEO of the organization, but now you're asking me to be a CEO of the company, so it's a good reason
When
for me to
should
leave.
so suppose I'm being interviewed as CEO's role?
Yes.
When should I start discussing these points?
Right at the time when you are negotiating your contract with the company.
Okay. So there's a possibility that the negotiation may fail because of these things.
Yes, but I think it's better to be safe and knowingly signing on the document, because tomorrow if you realize this, then I've seen people even at CEO level burn their fingers when they suddenly realize that, okay, they can't, if they don't continue, they will lose substantial wealth as far as ESOPs are concerned. So it's a very important aspect which is not given due importance in India. If you look at the markets like US, people are very, very careful about what they are signing on and what the change in control clauses are.
Okay, so people, anybody want to reach out to you for
Yes.
help, and if you can't get it through him, you can reach out to me. I'll pair him off
Right.
the queries to him. So our purpose is very simple, that it should become win-win situation. Nobody feels shortchanged, and please read the ESOP communication. I think we spoke enough time about it, but it's very important. People should read ESOP communication more carefully, and not only read once, but read every 3 months, because sometimes we lose track of what is written there. It is very important to keep all these things in mind. Friends, this is nothing to do with investment, is more to do with ESOP. So thank you very much for joining in. Really appreciate your time, and thank you very much.
Pleasure to be here. Yeah,
Thank you.
thank you.